Hello, Professor. My name is Yosit Tamnoya, and together with my teammate, Frank and Lindy, we are going to present a financial and stock performance analysis of Colgate Palmolive from 2020 to 2025. And now we're going to talk about a company overview. So Colgate Palmolive was listed on the New York Stock Exchange under the ticker symbol CL. It is one of the world leading consumer product companies. The company focuses on the four major business is the oral care, personal care, home care, and pet nutrition. Today, its products are sold in more than 200 countries and territories worldwide. And the company history began in 1806 when William Colgate established a starch, soap, and a candle business in New York City. And also another major milestone occurred in 1911 when the company distributed more than 2 million tubes of toothpaste and toothbrush to the school and dental hygienists, it helping to promote oral hygiene awareness. And in 1923, the company was officially incorporated in Delaware and continued expanding internationally. Another important milestone came in 1930 when the Colgate Palmolive was first listed on the New York Stock Exchange. Talk about business mix and market leadership. Now let's examine Colgate Palmolive business structure and competitive position. So looking at the sales mix in 2025, oral care is the company's largest business segment, contributing around 44% of the total sales, followed by pet nutrition 23%, personal care at 70%, and home care at 16%. So the data shows that the oral care remain the core drivers of Colgate Palmolive performance, and in addition to its strong sales mix, Colgate Palmolive also holds a dominant position in the global oral care market. The company controls approximately 40% of the global oral care market, making it a clear market leader. Compared to its competitor like Protect and Gamble's hold about 70%, while Unilever account for around 8%. So together, the top three companies control approximately 65% of the market. So between 2020 and 2025, the global economy faced several significant challenges. The COVID-19 pandemic disrupted supply chains, affected consumer behavior, and created uncertainty across the global market. At the same time, inflation increased in many countries, resulting in higher production and transportation costs. Rising interest rates, geopolitical tension, and currency volatility also created additional pressure for a multinational corporation. Despite these challenges, Colgate Palmolive demonstrates strong resilience. As a consumer staples company, its products remain essential purchase for a customer even during periods of economic uncertainty. Toward 2030, Colgate Palmolive expected global conditions to remain challenging. To support a future growth, the company is focusing on innovation, digital transformation, AI, and sustainability initiatives such as recyclable packaging and carbon reduction. These strategies are expected to strengthen the company's long-term competitiveness and support sustainability growth in the future.
So now I will present their financial analysis of Colgate Palmolive from 2020 to 2025 through several key indices. Let's start with the liquidity ratio. Colgate liquidity position became weaker during the period. The current ratio declined from 100.28 in 2022 to 0.83 in 2025, which means current assets were no longer enough to fully cover current liabilities. Quick ratio also dropped from 0.76 to 0.54, showing weaker short-term liquidity. However, cash ratio improved slightly over years, indicating stable short-term cash capacity. At the same time, net working turned negative from 2024, reaching about negative $1.14 billion in 2025. Despite risky-looking figure, Colgate is not in a cash crisis. It generates over $4 billion in operating cash flow. So the issue isn't operational weakness, it's tight liquidity structure due to heavy reliance on short-term financial and commercial paper. With solvency ratio, Colgate shows a high leverage position, but it still has a strong debt servicing ability. The TIE ratio decreased from around 20 times in 2020 to 12 times in 2025, although decline is still above the 3x benchmark, meaning Colgate is still comfortable with its interest expense. The cash ratio also declined from about 27 times to 14.8 times, but it still remains strong. Meanwhile, the total debt ratio increased from 93.1% to 97.8%, and the longer debt ratio rose from 86.9% to 95%. This indicates that Colgate relies heavily on debt financing. Leverage rose mainly from shrinking equity due to aggressive buybacks, not excessive debt, leaving Colgate with reduced financial flexibility rather than immediate insolvency risk. Moving to the turnover ratio, with inventory, receivable, fixed asset, and total assets turnover remain consistency or stable over years, highlights strong operational efficiency. However, one weakness is negative net working capital turnover, which again reflects the company dependence on short-term liabilities. This creates a contrast. Colgate operates efficiently, but its liquidity buffer is limited. Now let's discuss about the profitability. Colgate remained profitable, but profitability weakened in 2025. Profit margin fluctuated from around 16.4% in 2020 and declined to 10.46% in 2025. Then decline is suggesting that higher cost or weaker margin control. The ROAs reached a peak of about 18% in 2024, then dropped to 13.1% in 2025. Although this decline, the ROA level still relatively strong, showing that Colgate continued to generate solid return from its assets. The most noticeable point is ROE. ROE increased sharply in 2025. It reached 584.11%. The main reason is the reduced equity base caused by the share repurchase and high leverage. About DuPont analysis. DuPont analysis confirmed high REO effect. The equity multiplier increased from 29.5 to 44.7, significantly magnified shareholder returns through leverage. Therefore, Colgate profitability reflects strong operational capability, but the sustainability of this return depends heavily on maintaining financial discipline. Next, look at the market value ratio. The PE ratio fluctuated from 23.9 times in 2020 to 29.7 times in 2025, reflecting investor confidence in its stable brand, efficiency, and cash flow. However, the PS ratio declined from 6.7 times to 5.6 times, suggesting that the market became more cautious about sales valuation growth. The MP ratio increased sharply from 100 times to 313.5 times. It shows that Colgate market value became much higher than its book value, partly reflecting strong brand and reduced equity base. Overall market confidence in Colgate remains strong, but the valuation partly distorted by company capital allocation policy. About dividend policy, Colgate has a very strong dividend history, which is one of the biggest strengths. In 2025, Colgate achieved its 63 consecutive year of dividend increase and its 131 consecutive years of paying dividends. This makes Colgate very attractive for conservative and income-focused investor. The payout ratio also increased, that means less profit was retained for internal reinvestment and for the future growth. Finally, about the evaluate growth rate, because Colgate pays out a large portion its earning, its internal growth capacity become weaker. The internal growth rate decreased from around 8.10% in 2020 to 2.91% in 2025. This means the company has less ability to grow using only retained earning. The sustainable growth rate also fluctuates sharply and turned negative in 2024 and 2025. However, this result is partly an accounting effect caused by Colgate extremely high ROE and small equity base. Colgate growth is supported more by operating cash flow, debt financing, and share buybacks, and by retained earning accumulation.
老师好, I'm Lindy. I will be presenting COLGATE-PALMOLIVE's CR stock performance and investment outlook. Let's begin with the technical analysis on the monthly charts. CR is currently trading at $87.80. It's almost flat again, with its 20 months moving average light indicate weak upward momentum. Look at other indicator. Trend channel is downward. MACD is slightly positive but slack conviction. Relative strength index RSI is in a neutral zone at 50.57. History suggests that RSI level around 37 to 38 have often signal oversold condition and attractive entry points. Trading volume also declines, and now the price is struggling around the $90.5 resistance level. If the price of stock break out above this level and also confirmed by positive MACD in breakout trend channel, it could open an upside target near $108.13. But for now, there's no clear signal for new entries. Please caution and patience. Moving to the weekly charts to see the midterm trends, we can see more clearly bearish. The current price at $88.57, slightly above the 10-day moving average line, with still within the downward trend channel. MACD is positive but weak, and RSI at 53 reflect a neutral to bearish sentiment. More concerning is Elliott wave pattern showing an ABC correction which typically implies further downsides. Beyond this pattern, the potential downside target zone is around support level 74.3, a significant drop from current level. So again, we recommend existing investors should hold and new entrant remain patient. Wait for RSI risk over zone level for stronger confirmation from weekly and monthly MACDs and moving average. Break out above the trend channel 2. Now let's see the fundamental picture. COLGATE Palmolive stock performance over past 6 years can be divided into 4 phases. In phase 1, 2020 to 2021, is a pandemic year, so the demand for hygiene products rose steady gains. Stock price up about 30%. Phase 2, 2022 to 2023, is marked by sideways volatility due to inflation, supply chain issues, and rising interest rates, decreased 17.5%. In 2024, phase 3, the company broke out to all-time high, supported by margin recovery, strong earning, and growth in pet nutrition, peaked to 51%. Finally, phase 4 saw a correction of about 28%, driven by slower guidance, profit-taking, and valuation concern with the PE index about 25 times. Another aspect we consider are systematic and unsystematic risk. CL has a beta of 0.3, making it a classic defensive stock. Its essential consumer product ensures stable demand even in economic downturn. However, some unsystematic risk effects on stock performance like foreign currency exposure with 80% of sale overseas. And the second is commodity cost volatilities. The third is intense competition. And the last one is the retailer concentrations. Overall, CLs with low beta highlight its defensive strength, but firm-specific risk, especially currency and commodity exposure, shape performance. It remains a stable dividend-paying choice for conservative investors. Now let's examine how CL performed on a risk-adjusted basis compared to its industry peer represented by P&G, Unilever, and Just Right. In return metrics, COLGATE Palmolive delivered an arithmetic returns of 0.5% and geometric return of 0.39%, so a good return compared with peers. As the risk-return scatter plot, CL position at higher return, lower risk compared with peers, and also a combined view of standard deviation and Sharpe ratio indicate that CL delivery a best risk-adjusted performance. This is an idea for conservation investor with strong stability, low volatilities, and competitive returns. And is COLGATE Palmolive stock undervalued or overvalued? We apply the simple moving average methods using 6-year average of PE and EPS to calculate the mean PE is 28.3 times and the mean EPS is $2.79, giving a forecasted 2026 price at $78.96. Now comparing this to current market price, CL closed at around $88, significantly higher than our forecasted value, approximately 11 to 12% over valuations. Therefore, the combination of downward technical trends and fundamental valuation below current level lead us to conclude that CL is overvalued at present.
In conclusion, Colgate Palmolive remains a strong and stable company with a powerful brand, low volatility, strong cash flow, and an outstanding dividend history as a Dividend King. However, the company faces challenges including declining liquidity, high leverage, and slower growth, with its internal growth rate falling from 8.5 to 2.9%. While the fundamentals remain strong, the stock appears overvalued. Therefore, our recommendation is to hold and wait for a better entry point while management focus on improving and support future growth.